Hey, this is Bubble Analytics, and this week we're going to see if we can concoct a trading strategy around the volume. So when you have a look at volume, typically what you're seeing is the number of shares purchased on any given day. So we're going to consider three types: volume divided by the closing price, which biases towards cheaper stocks. Second type would be volume times the closing price, which is the most commonly used one, and the one we're going to use today, but tells you the dollar amount going into each different asset. And the third one is a relative volume, which is effectively today's volume versus its average, and is useful for picking out unusual activity, so unusually high or low trading activity within whatever asset you're looking at. And then from that volume data, we are going to apply the Williams %R indicator, which is a 17 bar rolling highest high or lowest low, creating an oscillator, which you will see on the chart in a second. So effectively what we're going to do is take the volume data and overlay a 17 period Williams %R indicator, that's in red below, which we're going to smooth slightly using a 3 period simple moving average. And then for our triggers, we are going to buy when volume %R crosses above 50, and we are going to sell when volume %R has been above 90 and turns lower. So quite a straightforward strategy, fairly easy to code up, and let's begin. So before we do that, please read the disclaimer. Okay, let's get ready to code it up then. So I've opened up a fresh Jupyter notebook, renamed it Vol, and I'm just going to click in here and hit Shift Return a few times in order to create some empty cells. I'm going to be copying and pasting from our template. Both the notebook and the template are available to download for free via our GitHub profile. The link is on the website here in the footer. So let's get started then. First thing we're going to do is import libraries. So I'm going to take that full section here and paste it into there, hit Shift Return to run it. So that's initialized in our codebook. Next step would be to download some data. And as usual, we're going to download 10 years worth of daily time frame data for QQQ, the NASDAQ 100 ETF. We tend to find that if your strategy works with QQQ, then you're going to find quite a few stocks that it's going to work for as well. The only difference I'm going to make this time is to get rid of this line here, because we don't want to delete the volume column. Obviously we're going to be playing around with volume today and trying to find a strategy with it. So let's now create different types of ways or different variations of playing with the volume. So I'm going to create a column within our data frame called vol. First variation is going to be the volume divided by the close. Basically this is normalization or vol normalization, because it overweights, as we explained before, because it overweights low price stocks, it evens things out. So if you think we had 5 million shares traded for Apple at 200 versus 5 million shares traded for a dollar stock, then obviously the volume for Apple on that day under this formula would be 25,000, and the volume for the dollar stock would be 5 million. But bearing in mind that Apple gets a lot more interest than the low price stocks, effectively it's a way of sort of normalizing volume for each of them. So if we now run this, what you should find is that we've got a new column called vol in here. So that's one variation. Next variation, I'm just going to comment that out. In fact, what we'll do is we'll just copy this whole thing. So next variation would be the volume multiplied by the closing price, and effectively what that's doing is giving you a monetary value for volume, and it tells you where the money's being invested, because you're going to find that it's higher values for the stocks that get institutional love, that kind of thing. So that is the one that we'll probably use today, or the one that I'm going to be using to construct a strategy. The third one then is relative volume, and I'm going to take this again and I'll probably have that twice actually. And so I'm going to change that to relvol. And you can use either. For the example here, I'm just using divided by. And then what we're going to do is say, what we're going to do is compare the latest value for relvol here versus its 20 period average. And what that's going to indicate is whether relative volume is sort of unusually high. So is the current value unusually high compared to the average? And you could create an indicator around there. So, or to do that, all we would say is relvol divided by relvol.rolling, and then give it whatever period you want, and then take the mean. So, and that's another way to sort of play around with volume. There's honestly quite a few other ways, but these are the ones that we're looking at today. For now, I'm just going to play around with this one, but obviously if you wanted to muck around with different variations and also different indicators and a bit later, that would be something definitely to have a look at. For our strategy today, we're going to use the Williams %R indicator, which we're going to modify a little bit, but it's effectively like the stochastic, or it's very close to a stochastic calculation, but the bit that we're looking for is here. So I'm just going to copy and paste that across so that I can see it. So we're going to define a function called Williams, and Williams is going to take in some data and then a look back period, and effectively it is the highest high minus the close divided by the highest high minus the lowest low. So on that basis then we need to define our highest high. So high then would be, if we take the vol and we take a rolling average of n, whatever our look back period is, and then we take the max value. So effectively all we're doing is saying take the values in our vol column and take the values in our vol column here and take the look back window, whatever we specify here, and of the last sort of 20 values tell us what the highest value is. And then the same thing for the low, but instead of max we're going to change that to min. So again, looking at the volume column or the vol column, take our look back period of whatever we specify and then return the lowest value. And then the close in this case is not going to be the closing price, it's just going to be the vol column. Is that a capital? It should be, yeah. Okay. So then our formula then for Williams is going to be high minus the close. We should probably put those in brackets. Divided by the high, oh, that should be in brackets again, shouldn't it? High minus low. And then we're meant to times that by negative 100. I'm going to change that just to 100, only because it makes no real difference, and it just, in my opinion anyway, looks a little bit better. So normally on the Williams %R, what you would see is an indicator that oscillates between minus 100 and 0. And instead I'm just going to have a one that oscillates from 0 at the bottom here all the way up to 100. So that's the only difference I'm making there. So, and then from that then we're going to return will. And now if I want to create a column within my data frame, so I'm going to call that Williams is equal to our function Williams, which takes in data from our data frame, and then a look back period. I think 14 is the normal one on that one. So, and there we go. So now we've got an indicator based off our volume calculation, and apart from the nan values, which I'm going to get rid of now, everything looks to be on order. So basically maximum is 100, minimum is 0, and then it oscillates in between. So I'm going to get rid of the nan values by, there we go. So all we're saying there is from our data frame df, drop the NAs, drop the NaN values, and then do it on the existing data frame. So, and if I now run that again, this is what we come out with. So now that we've got both a vol column and a Williams column, let's create a chart and display that. So I'm going to come down here and I'm just going to take all this section here, because we're creating a price chart with an indicator below. I'm going to take all this section here and I'll leave a bit of a gap there, and then we are going to be adding in our indicator data to our subplot. That comes in here, of which we're going to change this to whatever we called our column up here. So it's lowercase Williams, and then I'll change that to %R, and I'm going to make that red, and I'll tell you what as well, we'll make that 2, just so it stands out a little bit. And then we're going to take all of this section here, including add the H lines, and then we're just going to amend that a little bit. So obviously, so we want values probably at 80, and we're going to have a couple of these. So we want values at 80, values at 50, and values at 20, I'd say. So all that's going to do is put a horizontal line across our indicator, and then need all of that. Don't need to get rid of the hours because this is a daily chart. And then we're not going to save, well, I'm not going to save the image, so that's there. And then the only other thing I'm going to do is take our index and change that to the date, and that's just so that we see month and date on the x-axis. So I think that is it. Let's go and display the last 250 bars. We've got 2,500 rows, so I'll call that 2251, I guess there. So let's run all the cells and see what we get. So now you can see we've got a nice indicator, and we've got price above and the indicator below, and it's pretty choppy. So I think probably we're going to play with that a little bit, but for the time being, let's just see how we get on. So you want an oscillator with something like this, because you want overbought and oversold values in order to sort of trigger your entries and exits. But at the same time, if you have an indicator that is really choppy, so this is oversold, back out, oversold, back out, oversold again, that is not always a good thing, because you're going to get lots and lots of entries at that particular point. So for example, if you set your strategy to trigger a buy every time we were under 20 and then rose above it, you would get a buy signal here, 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 and then here again. So chances are you'd be buying in at this first point here, not hitting a profit target before, and then watching price over the next couple of weeks go a bit lower before eventually sort of coming in. So what you're ideally looking to do is smooth that over a little bit. And to do that, there's a couple of ways you can do it here, obviously, and we're going to use both of them actually. So the one thing that you can do is to change your look back period. So the bigger the look back period, the smoother the turn. If we run that again, you'll see it has changed a little bit, but not really that much. And the other way for the Williams to do this then is to smooth the actual Williams value. So if I call this sort of Will 1, and then if I take a rolling 3-period average of it, and then return Will 1 here, and we hit run again, we should find that we get a much smoother. Okay, so that's something that we can definitely work with here, right? Because even when we get oversold here, we don't really, for this sort of move down here, we don't get that oversold, but for this period here, we do definitely get very oversold. So that's the kind of thing that we're looking for, is something a bit smoother. And then obviously when we get overbought as well, you can see that it's not rare, but we don't have a million different overbought readings that are going to sort of tell us to get out of our long positions or anything. So a bit of a smoother indicator makes for an easier ride, I think, anyway. So next step then, we're going to create our signal column. So the signal column is what feeds the backtest. So what we need to do is create a column within our data frame that gives us a 1 where it's a buy signal, a 2 where it's a sell signal, or a 0 where there's no signal at all. So this function, all it does is take in data from our data frame here. It initializes a variable called signal, makes it the same length as the data frame and puts zeros in all there, and then we're running a loop here. So what we're saying is for I in the range of the length of our data frame here, run across everything in order, looking for our parameters to be hit. And when we see a buy signal, we put a 1, sell signal 2, and no signal, put a 0, and we create a little column called signal and pop that in there. So for our strategy then, I think what we are going to look at is moves above 50 and below 50. So you could use this for sort of oversold. So you could say, below 20 is oversold, or even below 30 is oversold. But you're not going to get that many buy signals. So you're going to end up with, over the last 10 years, like 50 trades or something like that, which is no good. So instead, what we're going to do is take buy signals when value rises back above 50. So that's when we'll get long. So when we're going to consider ourselves in bullish position when the indicator rises above 50. So that's the first step. So to do that, then we're going to say data.williams .ilock. So if yesterday's bar, so that would be I minus 1 for yesterday's bar. So if yesterday's bar is less than 50 and today's value, so data.williams.ilock I is greater than 50, so it's like a bullish cross, then put sell signal equals 1. So if I now run that, you've got a signal column here, and you can see there was a buy signal that came in here. So basically, if yesterday's value was under 50 and today's value is above 50, put a 1 in that column. That's our buy signal sort of thingy. And then for our sell signal, what we're looking for is overbought conditions that then drop. So we're not looking to, because things can stay overbought longer than you think. So we're not looking to say, well, when we rise above a certain level, get out. What we're going to say is when we've been above a certain level and then drop back again, that is our signal to get out. So in this case, what we're going to say is when we have a Williams value above 90, which then turns down and moves below 90, as in sort of turned over here, then that is going to be our signal to get out of the market. So if we say data.williams.ilock, so yesterday's value, I minus 1, is greater than 90, and data.williams.ilock, and today's value is less than 90, that's going to be our sell signal. Okay. So, what have I done here? Oh yeah, no bracket. There we go. So now we've got, hopefully, our sell signals plotted as well. So next step then will be to sort of visualize those on the chart. So I'm going to take this entire section here. All this does is create 2 new columns with long and short entries. So effectively, all it's doing is running through our data frame here, looking at the signal column. Where the signal column is 1 for a buy, it returns the value of the low column minus a small offset so that it's just outside the bar. And then same thing for the short entries. Runs through the data frame, looking at our signal column. Where it sees signal equals 2 for a sell signal, it's going to return the value of the high plus an offset. And all we're doing is creating 2 new columns within our chart, which if we have a look here, you will be able to see. So now we've got long entries and we've got a price that we can put a marker on. So this also, by the way, gives you how many buy signals we saw versus how many sell signals and the total number of rows in the data frame. So if I now want to represent our buy and sell signals on the chart, I can just come and take this section here. All we're doing is adding a little marker wherever we see a value in that long entries or short entries column. So if I add that in there, run the whole thing, what you should now see is little white arrows, up arrows for buy signals, and sell signals are these little gold crosses. So, all right, so we've got that. Let's go and test everything out. So now we've sort of cobbled together a strategy. We're going to go in and back test it. So if I go in and pull this entire section here, what we are going to do is just amend it slightly. So I'm going to get rid of this bit, and then I'm going to get rid of all of this bit. So okay, so effectively all we're going to do with this is return the value of our signal column, initialize it within the backtester, within the strategy, and then the only bit that we're adding in that we wouldn't normally have with backtesting would be this part here. All that does is return the price as at the close when you get a buy signal, and then we're going to key off that for stops and losses. So, and then when we run our back test, we're going to take the value in our data frame, tell it which strategy we want to run, which is this one here. Our starting cash, margin equals 1 equals no leverage. This says only one position at a time, and then this pays a commission. The total fee for a round trip buy and sell would be 0.1% under that commission there. And effectively all this is where we see a sell signal equals 1, a signal equals 1, that would be a buy. And so if we are already short, close that position, or if we don't have a position, either one, we buy with 99% of the capital available. And if the signal is 2, as in a sell signal, if we're already long or we don't have a position, close it if we do have a position, and then self.sellers get short with 99% of available capital. So for this one, we normally I would just muck around with it. Like if we run this raw, I'll show you. So if we run this raw, you can see we're in the market all of the time because we haven't set any stops or losses. What's happening there is, say for example, you're getting a buy signal here. Well, you're not selling that until you get a corresponding sell signal, which is here. So under that basis, you're going to be invested in the market all the time. You're not really going to have that many trades, although we do all right here. You're going to suffer all the drawdowns the market gave you, and your win rate typically that's quite high for a strategy without any sort of profit targets or anything like that. Your worst trade obviously is just what the market would give you. That's probably going to be on the short side. So what I would normally do is just comment out the actual sell. So we still want to close our longs every time we get a signal equals 2, but we don't want to short anything. And if we just run that, you can see we massively increase our, so if we just take the longs, you massively increase your profitability. If you have a look at the short side there, then these are just the short trades. You see you're losing money. So on the short side, the return was negative 45%. That's your drawdown as well. 57 trades, low win rate, and your worst trade came on the short side. So definitely the short side is something that we're going to have a look at first. So with shorts, you always want to have stops and losses really. So our take profit target on this one, I'm going to start at 2%. That's normally about right. So effectively, what we're saying there is take the profit at 98% of whatever the value is in that price. And then for a stop loss, and you definitely want a stop loss on the short side as well, we're going to stick the same thing. So it's 1.02 times price, as in 2%. So it's a 2% take profit and a 2% loss. And you can see you just about make a positive return there. You're not in the market very long. You're losing most of your trades, but your drawdown's reduced, your worst trades reduced. So probably not even worth having the short side, to be honest, but it does make a slight difference when we go and have a look at the long side. So for the long side, bearing in mind that, I mean, personally, I would always have a profit target. You wouldn't have to necessarily on this one. you can see you still make 369%, but you're invested all the time. And because you're invested all the time, your drawdowns and your risk of drawdowns is higher. So personally, I would always have a profit target. For this one, we came up with, I think it was 9%. So you're still, holding onto your trades quite a lot, but you increase your number of trades there. Your win rate's still good. Your drawdown is not great, but still better than the market would have given you, and you've reduced your market risk and really haven't really lost a huge amount. If you wanted to play with that a bit more, lowering it to say 5%, again, you're reducing your time in the market. Drawdown's about the same. Your win rate goes up, number of trades goes up. Your worst trade is still the same. Normally for the Qs, I would start around 3. If you go around 3%, again, number of trades goes up, win rate goes up, your drawdown comes down, your worst trade is still pretty bad, but you massively impact your return. So I think for this one, let's have a look at 7. What did 7 give you? Oh, not great. 5% seemed to be quite good for me, but I think the one that, when we had a look at it, returned the best would be 9%. So bearing in mind that we've got 147 trades, decent enough win rate, let's do a little bit of profit and loss. So I'm going to grab all this section here and pop that there, and then I'm also going to grab all of the Monte Carlo, and we'll just have a look at that and just see how risky it was to operate that strategy. So I'll get rid of that. I don't want to save the chart. Save for that one there. And then, so this is our vol strategy, wasn't it? So vol strategy, P&L. All right, so if I run that again, let's go and have a look at our profit and loss. Very important to visualize profit and loss. So first thing to note, we had a bad period here where our profit was 41k in June 2018, and then 22k in October 2019. Not good. So basically that had a really long period where it went sideways to down. So, and then probably your worst period here is 175k profit down to 114k profit, but relatively quick, over about 6 months. I think that's probably when the market was weak. But since that point, it's been up. So obviously, if you're running this strategy in the background or in combination with another strategy or lots of different other strategies, then you understand your risk now, because you can see that this strategy can go from sideways to down for long periods, and also is very likely to be copying what the market is. So if you wanted to avoid something like this, then you would need something that says, well, market's in very bearish condition, or we're currently experiencing a sustained downtrend within the market, and therefore I'm going to stop this strategy from trading. But in the main, let's have a look. So this is the Monte Carlo. What this does is tell you. Let's have a look. I've done it I've changed it to the percentage. So effectively, what we're doing is taking in the trades, which comes from stats here. So we're taking in our trades, and we are looking at the percentage gain or loss for each trade. And then all this does is randomize those trades, the trade order, at 100 times, and then visualize a new percent gain or loss on the chart here. So it's not too bad. But you were down in the worst strategy here. You were down, 32% before it got going. By visualizing them in a randomized order, you're basically saying, tell me what would happen if in the worst case all my losing trades came at the start. And that's probably that green line there. But overall, not too bad. And given that we haven't really done anything other than muck around with volume, it's not bad, is it really? So you can make a strategy from anything, can't you, really? So I think I'm going to leave that there for this week. So any questions or any sort of comments, please email us info@bubble-analytics.com. Thanks now.